Good morning, everybody, and welcome to our autumn budget analysis. Good to hear from you all, and thank you all for registering for this one. A bit of housekeeping first. So if you can't hear me via your computer, you'll see on screen now there's the login via telephone with the associated access code. Apologies if there's any technology issues. We should be dab hands at this now, but if there is, I apologise in advance. So my name is Phil Hartley. I'm tax director at Mitchell Charlesworth. I've worked in tax 15 years now, focused predominantly on corporate side of things, but in the main corporate, but I cover all the taxes as well. Don't hesitate to ask any questions during the webinar via the chat function, and I will answer these at the end of the webinar. If I don't get to all the questions at the end, I will get back in touch with you post-webinar. You can contact me directly should you wish to. My email address is on screen. It'll also be on screen at the end. You can also contact your associate partner, manager with any questions, and they'll direct them towards me. This session is being recorded and it will be circulated along with the slides following the webinar. So what we're going to talk about today. I'm going to quickly recap on previous announcements versus the current position. I'm going to talk about the main changes, really, which will all focus really on income tax, what changes have been made. Then specifically going to move on to salary dividend remuneration package and if that's still appropriate. Talk about the stealth tax, the biggest raising one that we've had this time, and what does that mean and how does it impact you and everybody else. What is happening with the property/savings income tax changes and how will they work. We're going to touch on capital gains tax, a bit of a revisit of the BADR changes and also the changes to employee ownership trust relief. Inheritance tax, we're going to, again, tweaks to the BPR and the APR changes, but just recap on those because they're coming in the not too distant future now. What was announced in relation to business taxes, any other points, bit of a summary, and then questions. So, just a recap as to what we already knew about following previous announcements. So before the budget on Wednesday, we knew that the thresholds for income tax were going to remain the same until April 2028. We knew that the dividend allowance was £500, that it's been maintained at that level. The annual exemption for capital gains tax is £3,000, and that is maintained at that level. Corporation tax rates will be a maximum of 25% and confirmed in the budget that won't change. We knew that business asset disposal relief rate would increase to 18% from April 2026, and that changes to business property relief and agricultural property relief were being implemented from April 2026, and the IHT on pensions was being implemented from April 2027. So, income tax changes, a lot of speculation prior to the budget as to what they were going to do. Was they just going to increase income tax for everybody? Then they backtracked on that. Talked about the thresholds, weren't sure what they're going to do. Lots of speculation, but this budget as a whole has resulted in a circa £15 billion worth of income tax rises. The bulk of that is coming from the thresholds. So as we just mentioned, the thresholds were meant to be frozen until April 2028, and they've extended that for a further 3 tax years. So now the thresholds will be frozen in their current form till April 2031. That is projected to raise circa £12 billion by 2030-31. So that is a significant tax rise. And there's the stealth tax that we'll come on to shortly. Income tax rates on employment and self-employment income have remained the same, but property income and savings income, and by savings income we mean interest, is increased on all bands by 2% from April 2027. So it'll increase to 22%, 42%, and 47% from April 2027. For dividends, it's a year earlier. It's the 2% as well, but it's only on the basic rate and the higher rate thresholds. There is no increase at the moment to the additional rate threshold. So that will give us tax rates of 10.75%, 35.75%, and 39.35%. And that is from April 2026. National insurance will be charged on pension contributions over £2,000 made by salary sacrifice, and that's coming in from April 2029. So a little bit way off yet on that one. We're not going to massively speak about that in this webinar because it's not a lot of information has been published on it just yet, and it's one for another 3 years or so. And we will revisit that in future webinars for sure. And income tax relief on VCT, which is venture capital trust investments, is going to fall from 30% to 20% from April 2026. So the big question that always crops up with this sort of thing when we change rates with dividends and change income tax positions is salary versus dividend. For owner managed businesses, is a small salary plus a dividend still the best way to remunerate ourselves, or should we be looking at just pure salary moving forward? So this first slide is a year-on-year comparison of the salary dividend remuneration package position. So we've got the gross income on the left-hand column, and in 25-26 that was providing a net income, as you can see on the second column in, and then this is the position for 26-27. So as you would expect with a rate increase across the board, the income is lowering as a result of the change. The net income even is lowering as a result of the increase in the rates. It does cap itself out though. So as you can see, we get to 125,000 and it's increased, but then at 150,000 and up 200,000, the difference in net income is the same. And that's because the additional rate band has not increased at this moment in time. That has stayed at 39.35%. But as you can see, for example, £50,000 salary dividend remuneration in a year, you are resulting in £1,000 less net income in your hands, unfortunately. But this slide shows, okay, well, we know about the difference, and it is a reduction in net income year on year. But compared to a salary only, are we still better off or not? So again, gross salary on the left-hand side, then it's the salary only. So what your net income from a salary only position. And the salary and dividend calculation is based on the same costs to the company. So we work out how much does a salary only cost the company and use that same cost to work out the salary dividend package and what's the difference in income there. So we can see on the second column in from the right, actually, again, we have more net income in our hands compared to salary only packages, but in comparison to 25-26, this is lower. And you can see where we're getting to a point where it is nearing leveling off, but there's still more net income in hand compared to a salary only position. So to summarize that, really, it is still beneficial, but that gap is continually closing. And if further changes are made to dividend rates in the future, or changes are made to top basic rates and employment rates of income tax, that gap might significantly close, and then a conversation is needed over salary dividend package and if that's still worthwhile. But at the moment, I think we're still in a much better position than via salary only position on remuneration. So the stealth tax. So it's continually discussed, and I've talked about this in the last few webinars, so apologies for those who've heard about this before, but very prevalent this time because of the extension that has been made. So in this budget, confirmed that the personal allowance and the income tax thresholds will be frozen to April 20 and not extended further. That was in the previous budget. It's been extended further this time. It's been moved to April 2031. And as I say, it relates to personal allowance and income tax thresholds whilst wages continue to rise. So we've got thresholds not changing, but wages are rising year on year, mainly with inflation. And effectively what that means is that the allowances and the thresholds have not increased with inflation, but in real terms, more tax is being paid on income than it would have been in the past. So I'm going to show on the next slide an example of inflation over the period April 2021 to April 2031, and I'm using a rate of 36% over that period in time. So what the first slide is going to demonstrate is the effective tax rate if the bands were raised with inflation, and then the second is going to with the frozen impact and what's the effective tax rate as a result of that. I'm not factoring in national insurance. I'm just purely focusing on the main income tax rates, and I'm not considering the property or saving income rates either. So this is the example in 2021-22, gross income on the left-hand side and the tax liability on that. And this is on assuming salary for this moment in time. So 2021-22 tax liabilities as listed, and there you've got your effective tax rates of accordingly, depending on the rate of income you have or level income you have. And then in if the thresholds and the personal allowance had increased with inflation, 2030-31, you've got effectively the same levels, except for when we get into the over 100 grand bracket, because historically that 100 grand threshold has never increased. So the percentage is different here in terms of 136,000, for example. But as you can see, mainly, if we compare it to the previous slide, apart from the 106,000 to compare to 100,000 level, those percentages are staying the same. They're not they haven't moved at all, because thresholds have risen with inflation, and therefore you're roughly paying the same level of tax or effective rate of tax even as you were in 21 compared to April 31. Here, though, this is the example of the impact with no change in the threshold. So this is where we are now. So by 2030-31, again, income is increased in line with inflation, but the tax liability figures compared to the previous slide are significantly higher. And the effective tax rates on those areas is also significantly higher compared to what it would have been if it increased inflation. I think that demonstrates the impact of the freeze in the thresholds ultimately, because that freeze in thresholds is dragging more people into the higher rates of tax. And just as an example, if we go a couple of slides back, at £40,000, that was a basic rate taxpayer in 21-22, and then by the time we get to 2030-31, with the no change in thresholds, we drag that individual into the higher rate of tax. And I think the statistic that came out for post-budget was it is anticipated that of working people, at least 25% will be a higher rate taxpayer or more by the time the freeze ends. So that, a quarter of the working population will be paying higher rate tax, compared to about 15% back in 2021 even. So again, massive shift, more tax being risen, and that's how they're forecasting to generate this circa £12 billion in extra tax from this measure alone. So the property and the savings income changes. So there was, again, a heck of a lot of speculation on property income in particular, and how could that change? Would national insurance be introduced or not? And what we've ended up with is effectively national insurance being introduced, almost the higher rate of national insurance being introduced on property income, and on the interest income at the moment. So as we mentioned before, the rates are increasing from 20, 40 and 45% to 22, 42 and 47% from April 2027. So not this next tax year upcoming, the tax year after that. And that's almost like adding on the 2% higher rate national insurance, shall we say, that employees pay on their income. The mortgage interest restriction, so at the minute that's at 20%, and it's been confirmed in the legislation and the information provided post budget that will increase to 22%. So it'll align itself with the basic rate tax you will pay on property income moving forward. What the budget did, it went further than probably what anybody was anticipating, and also applied these rates to interest income from April 2027 as well. So there wasn't much talk about that in the lead up to the budget, but they've applied it to, they call it savings income, but when we get into the nitty gritty, it's mainly on interest. The relief on property income and savings incomes are the same. So again, you're only going to be assessed on your profits from property. And savings income, there is savings allowances available to offset potentially. So they've remained the same to mitigate this position as well. So with the property income changes, a question we're seeing a lot, and a lot of work we've done with clients recently as well, is, well, should we be considering incorporating our property portfolio into a limited company? And I think that question is only going to become more prevalent now that the rate has increased as well. So I think with these sides of things, there's a couple of factors that need to be considered, and it's not just income tax that needs to be considered as well. So when I'm speaking with clients on this matter, there's always that a factor of, as a self-assessment and income tax, you're being assessed on all the property income, and you're not necessarily taking all that property income and spending all that property income yourself personally. So the first question is, if you do incorporate into a limited company, would you be extracting all the income available from that limited company to live off effectively? And if that's the case, it's not worthwhile to incorporate in potentially, because as well as paying corporation tax on the profits, you're then extracting and paying dividend tax rates, which have increased at the same time. So that's one factor to consider. But if extraction is going to be limited, if it's almost like works as a pension pot for you in that respect, then it is definitely worth something to consider. Mortgage interest is fully relievable in company compared to personally owned. And so that would be up to 25% compared to the cap at 22%. That is a benefit, and that needs to be factored in with the overall what's your effective tax rate on property income personally compared to how much tax you'd pay in the limited company. What we also need to consider is two other taxes in particular: capital gains tax. So what with property portfolios, we look to see if incorporation relief is available, and that effectively rolls over the gain from the properties that you've bought personally into the shares that you'll own in the limited company in the future. There's complex rules around incorporation relief. I'm not going to go to too much detail about them now, but if incorporation relief isn't available, any transfers from you personally into a limited company is deemed to be a disposal at market value and can trigger capital gains tax at 24%. So must be considered in more detail, must be factored into the discussions. And similarly with stamp duty land tax as well. As an individual transferring property, that is deemed to have happened at market value, and you'll pay stamp duty land tax at the appropriate rates. But if the portfolio is a partnership, it could potentially be exempt. So something that needs to be factored in, considered and planned in more detail moving forwards. But it's, I think, something that's definitely going to become more prevalent in the lead up to April 2027. And something that if you are an owner of a portfolio of properties and considering your own positions, seek advice as soon as you can. Have a think about what you need to do, what plans need to be put in place, and if this is something worthwhile for you or not. So the capital gains tax changes. Now, on the face of it, they were pretty minor in this budget. And, there wasn't massive changes like we had last year where we had rate increases and reduction in business asset disposal relief. And there was only a few around the edge changes that impact people like myself when we're considering certain strategies and certain planning that we put in place. But the big one was the employee ownership trust. And I'll come on to that in a little bit more detail in a moment. But headline rates are going to remain the same. Capital gains tax rates at 18%, 24% for all capital gains moving forward. Business asset disposal relief, the £1 million lifetime allowance has remained. That's not changed. And as we already knew, that is the rate that you pay as on business asset disposal relief is increasing to 18% from April 2026. Incorporation relief, which I just mentioned with the property income, that used to be an automatic relief. You didn't have to put anything in your tax returns. If you qualified for it, you got it. And they've changed that now, and you're going to have to make a claim through the CGT pages of the tax return. Something that if you're doing anything in that area, advisors will make sure that that's being done. But as I mentioned, the biggest change was in relation to treatment of sales to employee ownership trusts. And what prior to budget day, a sale to an EOT was exempt from capital gains tax, provided that the EOT rules had been met at the point of sale and 4 years after the sale as well. So long as the rules have been met, which I won't go into in massive detail now because they are relatively complex rules, but if you met the rules, the gain was fully exempt from capital gains tax. However, on budget day, and this was specifically a change that they made on the day, so any disposal afterwards are affected by these rules. And the relief on the sale to an EOT was reduced from 100% exempt to 50% exempt. And the balance, the remaining 50%, is subject to capital gains tax. But crucially, in the legislation, the draft legislation that's been published, it's subject to capital gains tax at the main rate of capital gains tax, i.e. 24%. So the draft legislation is specifically saying we cannot claim business asset disposal relief or investor relief on the balance that's subject to capital gains tax. So instead of being able to claim, for example, potentially 18% on the up to £1 million, it's all at 24% regardless. So what this schedule, I mean, the first schedule is a bit of an eye-opener. This is not a great position schedule because, as you can see, level of gain on the left-hand side, pre-26th of November 25, if it met all the definitions of an employee ownership trust disposal, no capital gains tax will be paid. Post 26 on 26th of November 25 and onwards, significantly more capital gains tax is going to have to be paid on those types of disposals. But when we look at it from a point of view of, okay, let's compare that to a third-party sale of shares, for example. Again, we've got the level of gain as we had on the previous slide. We've got the employee ownership trust sale figures as we previously had. And what this next column, the capital gains tax 25-26, is showing is, well, how much capital gains tax would we pay if we sold to a third party? So the calculation there is assuming that a full lifetime allowance is available on a third-party sale for business asset disposal relief, and it factors in annual exemption allowance of £3,000 as well. So you can see there is still a saving with the employee ownership trust at the moment. Minimal in terms of a level of gain up to, let's say, £1 million. And that maybe then factor in and think about, well, is this worthwhile at this point if it's a purely tax-focused disposal? Because you might go, well, the saving I'm generating is going to be outlined by the cost and the complexity of the trust owning the company and the additional reporting requirements that's going to entail. But once you get into higher figures, as you can see, a £2.5 million sale to an EOT is still generating a saving of £200,000 in capital gains tax compared to a sale to a third party. And post April 2026, when the business asset disposal relief rate goes to 18%, that figure is even better. Further capital gains tax saving there compared to a sale on an EOT. So, even at £1 million, you're talking a 60 grand saving in capital gains tax, which is potentially going to be worthwhile and much less compared to a third party sale. Obviously, with these sort of things, it's all about circumstance as well. And, is a third-party sale more beneficial route to undertake? Is an employee ownership trust the right thing for you and your company moving forward? But as you can see, yes, the headline rate grabber is, oh, Christ, this is a lot more tax to pay on employee ownership trusts sales, but moving forward, but there's still a saving compared to capital gains tax on a third-party sale, for example. So employee ownership trust is something still to consider. Got to be right for you and your business. And just a recapping of the business asset disposal relief side of things, kind of seen it in the last two slides. But again, we've got the additional capital gains tax that's going to be due now as a result of business asset disposal relief going from 14% to 18%. You can see it goes up at just short of 20,000, just short of 40,000, and then plateaus at £40,000. So any disposals post 6th of April 2026 will, in all likelihood, have an additional £40,000 in tax due compared to pre-April 6th of April 2026. So if any transactions are on the go at the minute, if they can be done before then, you have got tax saving. If not, then there's a bit more tax to pay on that disposal. Still lower rates than income tax, though, which is a positive thing. So with inheritance tax, again, so much speculation about inheritance tax prior to, but would they make even more changes, and how could those changes be done? And again, it was a relatively quiet one from inheritance tax point of view compared to this time last year. A lot of talk about would they change the rules surrounding gifts and the making of those gifts, and that hasn't changed from the budget. So the 7-year rule in terms of you make a gift and within 7 years it falls out of your estate, that still applies. So that's a bit of positive news from an inheritance tax point of view, helps with any planning that can be undertaken in that area. However, so we've got the current thresholds, the nil rate band and the residential nil rate band, 325 and 175,000. They were originally extended last year to April 2030 to be frozen at that rate. And that's been added on to by further year, so to April 2031. Aligns itself with the income tax rate thresholds being frozen as well. Not ideal. Again, I mean, my example before, if those were risen with inflation, they would be significantly higher now as well. Unfortunately, they haven't, but then it's been extended by a further year. We'll wait till another 6 years to find out what will raise to eventually. But at the moment, they're still and will continue to be on nil rate bands. So from April 2027, unused pensions within an individual estate will be subject to inheritance tax, and there was a lot of chat about who would pay that. So initially it was going to be the pension fund being liable to pay the liability. That has changed, and it's now going to be the responsibility of the personal representatives to calculate and pay the IHT. That's been confirmed in the budget. Again, a lot of mechanics behind the scenes to how that will actually work in practice, and that information will need to come in due course. But we will wait and see what they have to say on that. But it's not going to be the responsibility of the pension fund. It's going to be the responsibility of the personal representatives. And in the last budget, we had the significant changes announced to business property relief and agricultural property relief from April 2026. And they've remained in place. So they haven't changed. So just as a recap of what they are, prior to April 2026, you could get business property relief or agricultural property on either 100% or 50% relief on the full value of the asset. So there's no cap in place. If you qualified for 100% relief, you got 100% relief under business property relief and agricultural property relief. If you qualify 50% relief, you got 50% relief. But from April 2026, the rules changed that position. So it was now your first £1 million of combined value under these reliefs will get a 100% relief. And the value over and above £1 million will get 50% relief. So effectively creating a 20% inheritance tax charge on the amount over and above £1 million in the estate. But what wasn't clear when they announced it last year, and there's been lots of discussions about this, is if the £1 million allowance can be transferred to a spouse and partner if it's unused on the death of the first spouse and partner. A spouse or civil partner. And that's what we have with the nil rate bands, for example. If they're unused on the death of the first spouse or civil partner, then they are transferred to the surviving spouse slash civil partner. So it's been confirmed in the budget that would allow that to happen. So the £1 million allowance, if unused at the day of death of the first spouse slash civil partner, will be transferred to the surviving partner. So that could potentially then mean that up to £3 million of allowances are available in that example, with the combined nil rate band and residential nil rate band, plus up to £2 million of allowance on this side of things. Planning needs to be considered though, because you could start losing your residential nil rate band in tandem with the pension if your residential estate is, or your inheritance estate even, sorry, is over and above £2 million. So again, consideration planning is going to be needed on inheritance tax. I know my colleagues in the tax team are doing a lot of work in this area already, and something that will continue to need to be looked at and considered by people moving forwards. So business taxes pretty light on this budget in terms of business taxes. Obviously last year we had the increase to employers' national insurance, which hit businesses hard. There's not loads of specific business tax in new business tax ideas coming in. One thing that was brought in was this new 40% first year allowance for capital allowances purposes. So what a first year allowance is if you buy a new and unused piece of plant machinery, you do have a position where you can claim in the main 100% relief. That is via annual investment allowance or full expensing in the main. But there is a few anomalies within the system where if a company is buying plant and machinery for leasing purposes, it can't claim full expensing, for example, and unincorporated businesses can't claim full expensing. They can both claim annual investment allowance, but they can't claim the additional full expensing position. So what this new allowance brings in is that ability to claim 40% of the cost upfront as a allowable cost in that year. For companies that are leasing the assets out to other entities or for unincorporated businesses. But annual investment allowance takes precedence over that because you have £1 million per annum that you can use for annual investment allowance, and that will generate more tax relief than the 40% first year allowance. On the flip of that, we had the writing down allowance on the main pool we reduced from 18% per annum to 14% per annum from April 2026. So what that is where in the past, we potentially had annual investment allowance. We've not had your super deductions that we had for a period of time and then your full expensing. And we have a value in what we call the main pool that only gets written down over quite a long period of time. And initially it was at 18%. And that gave an amount deduction year on year to reduce corporation taxable profits by. That's reduced from 18% to 14%. So unfortunately, that will mean that those historical balances that are there will take longer to realise now because that 14% rate is obviously lower than the 18% rate we were getting previously. So that is unfortunately a bit of a tax cut for companies in that sort of situation or incorporated businesses in that sort of situation. The 100% first year allowances that we have on electric cars and charging points, they were due to end in April 2026, and that's been extended to a further year to April 2027. That could be something that keeps getting extended year on year. We'll have to wait and see. But yeah, at the moment, 100% first year allowance on pure electric vehicles and for electric charging points will carry on until April 2027. There are quite a lot of changes to business rates. So there's permanent lower rates for retail, hospitality and leisure properties and a support package for sectors hit hardest by revaluations from April 2026. If you're in that sort of situation, something to consider and have a look at and make sure that you're maximising the relief you have available to you. There's quite a lot of changes to Enterprise Management Incentive Scheme from the 6th of April 2026. So what that is it's a tax advantage share option scheme. So you can issue options to employees in the business, and generally speaking, there'll be no income tax, no national insurance on the issuing or exercising of those options, and any gain made on the sale of those options will be subject to capital gains tax rather than income tax. So it's quite a lucrative way and a beneficial way of rewarding key employees in the business and keeping them tied into the future activities of the business. And what they've done is increase certain thresholds that were in place for this scheme. So for example, a company could issue a maximum of £3 million of in options value to its employees prior to the 6th of April 2026. They've doubled that now to £6 million. If the company had gross assets over £30 million, it couldn't claim Enterprise Management Incentive Scheme. And that's been quadrupled to £120 million. And if you have more than 250 employees in the business, you couldn't claim EMI scheme either. That's been doubled to 500 employees now. And there was a maximum 10-year limit on the time period you can own the options from to when you have to exercise them. That's been increased now to a maximum of 15 years. And similarly, we've had changes to Enterprise Incentive Scheme and Venture Capital Trust reliefs. So prior to the 6th of April 2026, gross assets were £15 million pre-share issue and £16 million post-share issue. And that's now increased to £30 million pre-share issue and £35 million immediately after share issue. You could have an annual investment limit before these changes of £5 million for standard companies and £10 million for knowledge-intensive companies. And that's increased to £10 million and £20 million respectively. And there's a lifetime investment limit before of 12 million for standard and 20 million for knowledge intensive. And that's increased to 24 million and 40 million respectively as well. But as mentioned earlier, the income tax relief on venture capital trust investment is reduced from 30% to 20% at the same time. Just some other bits of ones to consider and some things that were announced with the budget. So national living wage, that's going to increase to £12.71 from £12.21 per hour from the 1st of April 2026. And minimum wage for 18 to 20-year-olds is increasing to £10.85 from £10. And for 16 to 17-year-olds, it's increasing to £8 per hour. So that, as much as we're saying there's not lots gone on for businesses, that is a big hit for business because it's businesses that suffer that cost. So those increases, particularly if you're thinking in the retail, hospitality, leisure sectors, in particular, on top of the employers' national insurance increase of last year, that could be quite a hefty hit for them, unfortunately. Tax treatment of remote and online gambling duty singly changed from 1st of April 2026. I think the headline grabber was it's going from 21% to 40%. If you're in that area in particular, you need to consider those in more detail. Late filing penalties for corporation tax to double for filing dates on or after the 1st of April 2026. So at the minute we have £100 and then it increases the more it's late, effectively. That basic penalty now is going to be £200 and the following penalties will increase in line as well. So again, just something to be careful of, something to remember about, and making sure that those corporation tax returns are being filed on time. First year that's really going to impact is your 30th of April 2025 year ends, because they're due to be submitted by the 30th of April 2026. We have the mansion tax. It's not actually called the mansion tax in all legislation, but that's what has been bandied around in the press, so I've used that terminology. And that'll start on properties over £2 million, residential properties over £2 million, with a minimum charge of £2,500. And the charge goes up the higher value your property is, and there's a maximum charge of £7,500. They've said that's going to be collected by a council tax, and it's going to be introduced from April 2028. So again, we'll need a little bit more information as to how that's going to fully work in the future, and how they're going to value the properties and when they're valuing the properties. But we know it's going to be collected by a council tax, and it's introduced from April 2028. Interestingly, on the vehicle exercise duty, so we're seeing more electric vehicles on the roads now. So they've got that balance where actually they were paying, you get your fuel duty, and that fuel duty is dropping, and they've extended that 5p cut in fuel duty to September 2026. But electric vehicles aren't necessarily paying that level. So they're bringing in this new 3p per mile electric vehicle exercise duty from the 1st of April 2028. A lot more detail needed because I'm not quite sure how they're going to work out how many miles somebody's done in an electric vehicle in a year. Is there something that's going to have to be fed into a system? Is it all based on the self-assessment type scenario? I'm not quite sure how that will work, and more information is going to be needed. But if it does work, I could possibly see it's something that then comes in for petrol, hybrids, and diesel cars as well. Because if you get real-time information on this, you're potentially going to increase the amount of tax you're going to take from fuel duty and electric vehicle exercise duty. So, in summary, having raised £40 billion in the 2024 budget in taxes, this budget is, with another £26 billion in tax raising, is taken to £66 billion in Rachel Reeves's budget. And actually, the startling figure is now that the tax take is 38% of GDP. So it's at the highest rate it has ever been at since records began. And the changes to income tax, they're the most significant ones, the changes to income tax. And it will impact pretty much everybody. Particularly the freeze in the thresholds is impacting pretty much everybody. And it impacts pension holders because the personal allowance is increasing, impacts workers as they get dragged into higher rates of tax, and impacts owner-managed businesses because they're being dragged higher rates with their dividends and the increase in the dividend tax rates as well, and property income holders because of the rate increase there as well. So they're massive changes overall. As we've mentioned before, and I mentioned again, the freeze on the thresholds is the biggest one, and it's the most punitive tax rise in my view, dragging a quarter of working taxpayers into the high rate bands by 2030-31, and that's why it's generated so much money for them moving forward. As we've discussed in quite a bit of detail today, the dividend and the property tax, they need considering in more detail, and planning will be needed on remuneration, on potentially property incorporation, and how that will work moving forward. the changes to employee ownership trust, they're significant. There's no doubt about that. And it might curtail the popularity of these moving forward. But as we've shown, I think there's still place for them. You know, if there isn't a willing third party market to sell into, there's still place for it. It's still going to save you a bit of tax in that respect. What's interesting in the post budget media rounds is she's not promising to not increase tax again in the future. And I don't know if this is the end or not. What it seems like is it's a lot of front loading. So there's more borrowing having to be made because all these tax increases are towards the end of the Parliament. So if it doesn't go to plan, I think she'll have to come back to the tap again, unfortunately. Fingers crossed she doesn't, but we'll have to wait and see. And now on to if anybody's got any questions. I'm just going to check the comments to see. Or the chat function to see if there's any comments. By all means, please do put any comments in, any questions you have. I'll give it a couple of minutes in case we haven't got any. I don't think there's any come through at the moment. So I'll just give it a couple of minutes just to see if anybody does have anything. You can always, my email details there on screen. The shares have been shared after the webinar, so you'll have my details as well. You can always get in touch with me or one of our team to chat through any of these positions in more detail. Doesn't look like. Oh, here we go. A couple are coming through now. So, guessing from the question that we have is, how does this impact on properties in a trust? So the trust, I would suggest, depends on the nature of the trust. So discretionary trust pays at the higher rate. So I would assume it's going to go up to 47%. And if it's a settlement-based trust, they will increase as well because they match the income tax rate. So I would feel it's going to do that, I would have thought. When I've compared the salary and dividends, I've assumed a rate of 25% for corporation tax purposes. That obviously may not be the case for your specific companies and your specific businesses, but it's 25% rate that I've utilised. And if I can see the full question here. So does the £2,000 cap on salary second apply to employee and employer contributions, i.e. combined total 4,000? I don't believe it does because the employer contributions aren't subject to tax or national insurance anyway. So it's just the employee contributions that are. And the employee contributions is the one they're trying to get around, in my view. So I think the employee contribution will be subject to the cap of 2,000. I don't think there'll be a cap on them. There's no cap on employer contributions as far as I'm aware. Equally, and important to note, the income tax will not, you'll still get the income tax benefit over and above the £2,000 cap. It's just on national insurance at the moment. And I think, yeah, that's all the questions that I've had so far. But if there's any questions you do have, please do get in touch. And you can drop me an email, say details on screen. Thank you very much, everybody, for your time today. Hope you found that useful. Digest as much of it as we possibly can in that short period of time. And if you do have any questions, please do get in touch. I'm more than happy to answer them, and the wider team are more happy to answer them as well. Thank you very much, and see you all again soon.